Biggest S&P 500 movers, on Thursday 29th, and top Nasdaq stock up to 87% in 24 hours. Here are 5 highlights. 1. According to Fundstrat's Tom Lee, stocks could still perform well this year even if rate cuts are fewer than markets initially expected, and the S&P 500 could rise to 5,700 by the end of the year. 2. Affirm Holdings. Revenue jumped 48% year-over-year to $659 million in the period. 3. Top daily performance in the S&P 500 belonged to shares of Best Buy. 4. Top Nasdaq stock rose 87% today, but why? 5. Nvidia shares fell 6.4% on the day despite reporting better than expected quarterly results, so why did investors not like it? We will explain. The S&P 500 ended slightly lower, while the Nasdaq Composite dropped 0.2%, with both indexes losing momentum late in the session as Nvidia's decline intensified. Meanwhile, the Dow Jones Industrial Average rose 0.6%, closing at a record high for the third time in 4 days. As August draws to a close, major indexes are wrapping up a volatile month near where they began. Heading into the final trading session, the S&P 500 and Dow Jones Industrial Average are up 1.3% and 1.2%, respectively, for the month, while the Nasdaq Composite is down 0.5%. The yield on 10-year Treasuries, which reflects market expectations for interest rates, edged up to 3.86% from 3.84% the previous day. Gold futures rose slightly to around $2,550 per ounce, while Bitcoin remained steady at about $59,500 after briefly surpassing $61,000 earlier in the day. Here are the top S&P 500 movers. Best Buy, BBY, led the S&P 500 on Thursday, soaring 14.1% after the electronics retailer reported better than expected second quarter revenue and net income. Despite a year-over-year decline in comparable store sales, Best Buy highlighted growth in tablet and computer sales during the quarter and raised its full-year profit forecast, citing expectations of uneven consumer behavior. Medical device maker Cooper Companies, COO, also topped sales and profit forecasts in its latest results, raised its annual outlook, and saw its shares jump 11.8%. The company credited gains in market share for contact lenses, strong demand in its fertility and surgical businesses, and an overall positive outlook. West Pharmaceutical Services, WST, which produces packaging and delivery systems for injectable pharmaceuticals, added 5.8% on Thursday. West Pharma shares had previously plunged in late July after cutting its full-year sales and profit forecasts due to lower demand as biotech customers managed existing inventories, but the stock has been trending higher since. GE Vernova, GEV, shares hit an all-time high after William Blair analyst Jed Dorsheimer initiated coverage of the power generation equipment and services company with an outperform rating, highlighting the growing energy demand to power AI products. Dorsheimer argued that natural gas and gas turbine power are underappreciated and necessary, as renewable sources alone cannot meet the burgeoning electricity demand. He suggested GE Vernova is best positioned to benefit as the energy sector balances pragmatism with green energy ideals, estimating a target share price of $216. Affirm Holdings, AFRM, surged more than 30% after the buy now, pay later, BNPL, fintech company reported better than expected fiscal fourth quarter results and strong guidance. Revenue jumped 48% year-over-year to $659 million, and the company's loss narrowed significantly to $45 million, from $206 million a year earlier. Both figures beat analysts' expectations, with gross merchandise volume rising 32% to $7.2 billion. Here are the top S&P 500 decliners. Dollar General, DG, shares plunged 32.2%, marking the steepest decline among S&P 500 stocks. The discount retailer's stock tumbled after second quarter sales and profits fell short of analysts' expectations, citing financial challenges faced by its customers. Despite the weak sales, the company emphasized initiatives to improve store value and convenience. Shares of rival Dollar Tree, DLTR, also dropped 10.2%. NetApp, NTAP, shares fell 9.6% following its quarterly earnings report. Although sales and profits exceeded forecasts, driven by strong performance in all-flash memory arrays, the company warned of ongoing challenges as customers limit spending on storage and IT investments amid an uncertain macroeconomic landscape. Nvidia, NVDA, shares declined 6.4%. Despite reporting better than expected quarterly results, concerns arose about the sustainability of the AI chip giant's rapid growth trajectory and doubts about delays. Nvidia addressed concerns about potential delays with its Blackwell architecture, stating, "We shipped customer samples of our Blackwell architecture in the second quarter. We made changes to the Blackwell GPU mask to enhance production yield. The production ramp for Blackwell is set to start in the fourth quarter and will continue into fiscal 2026. The company expects several $billion in Blackwell revenue in Q4. Salesforce, CRM, shares slipped 0.7%, reversing earlier gains, after the company's earnings beat expectations on both revenue and profit. And here is the top Nasdaq stock that rose 87% today, and the reason behind. Shares of XORTX Therapeutics surged after recent research papers highlighted the genetic regulation of xanthine oxidase, supporting the company's approach to treating kidney and other diseases. The stock climbed 87% to $2.15, with trading volume exceeding 142 million shares on Thursday, compared to a 65-day average of 64,115. Shares traded within an intraday range of $1.35 to $2.60 but remain down about 9% year-to-date. Xanthine oxidase is an enzyme involved in the breakdown of purine nucleotides, producing byproducts that can harm the circulatory system and tissue during disease. XORTX believes recent research suggests genetic factors may lead to overexpression of this enzyme, and its treatments focus on inhibiting xanthine oxidase, particularly for kidney and other diseases. XORTX recently announced it will present at the American Society of Nephrology's Kidney Week in October, with an abstract titled "Xanthine Oxidase in Rats, Mice, and Humans with Polycystic Kidney Disease" having been accepted for presentation. Third-party opinions about the future of the S&P 500, dwindling expectations for Fed rate cuts may not derail the stock market's upward momentum for the rest of the year, according to Tom Lee, head of research at Fundstrat. Lee, one of Wall Street's most bullish analysts, predicts the S&P 500 could climb to 5,700 by year-end, suggesting a 13% upside for the benchmark index. Lee noted that current conditions appear to support his outlook. Corporate earnings remain robust, with the S&P 500 expected to see at least 7% earnings growth this quarter, according to FactSet. Economic growth has also shown resilience, with the Atlanta Fed projecting a 2.9% GDP growth rate for the first quarter. "We don't need the Fed to make 3 cuts," Lee added, emphasizing that the major risk for stocks would be if inflation unexpectedly heats up, potentially prompting the Fed to raise rates again. Recent hot inflation data has tempered investor expectations for Fed rate cuts, with stocks declining over the past week as markets adjusted their outlooks. According to the CME Fed Watch tool, investors now anticipate just 1 or 2 rate cuts in 2024, down from 6 cuts projected earlier this year. What to look ahead? On the economic front, weekly jobless claims released Thursday met expectations, while a revised GDP report showed the economy grew slightly more than initially estimated in the second quarter. Market participants are now focused on Friday's release of the Personal Consumption Expenditures (PCE) index, the Federal Reserve's preferred measure of inflation. Investors are closely monitoring these economic indicators for insights into how they might influence the Fed's decisions on interest rates. Last week, Fed Chair Jerome Powell signaled that rate cuts are on the horizon, but emphasized that the pace and scale of easing will depend on incoming data. Thanks for watching. Good luck and good profit. Edward Cash Trader. If you would like to support us, feel free to subscribe and share with your friends.